Hi, today's topic is how investors get fooled and what you should know. The best investment you can make is the one you control yourself. If you give your money to another for them to control, then you are the fool. But even this can go wrong. You need knowledge. Let me introduce you to a simple diagram that will assist you throughout your life, particularly with property assets. This diagram will always protect you before you make a decision. Why? Because you will always ask yourself, where is the market value line? You will never want to buy above it because you will be hurting yourself. Please view my video on where property value stops and business value starts. Many years ago, a large public company leased a large warehouse building in a prominent commercial location to one of its subsidiary companies for twice the market rental and created a lease for 10 years with a right of renewal for a further 10 years and put the property up for auction with one of the large commercial realtors. An investor purchased the property at auction and paid considerably more than the market value. He then settled and he did not receive any rent for 3 months. And then the tenant declared themselves bankrupt and vacated the property. I was commissioned to auction off all the contents by public auction which duly occurred prior to the bankruptcy notice. I was then approached by the buyer or investor to release the premises, which could only be done at or around market rental rates, not the inflated rentals on the lease. For those who have the ability to process this story, it means that a large public company was determined to commit commercial fraud on someone. It also means that the large real estate company that conducted the auction was also complicit in this deal. They must have known that the rental rates were inflated. The moral to this story is never buy an investment based on a lease document and the passing rental without assessing the market. If you do, then sorry, you are the fool. The best way to negate high valuations or high numbers is the substitution effect. If that tenant leaves, what is the substitution rate or how much can I release this premises for? Now, unfortunately, the market value line moves all the time. For some assets, it moves slowly, but for others, it can move rapidly. So how do we find the value of any asset? Well, it's easy, or the concept is easy, but it may take a little work. Field work, research and effort. It's called the funnel effect. Every asset has to be worth somewhere between X and Y, and this is how you find the value or the market value line. Now, to find values or market values, you must get them from the marketplace. You cannot invent values. They are either supported by markets or they are not. This makes mockery of invented methodologies such as EBITs, EBITDAs and discounted cash flows. I would like to introduce you to a concept known as now markets and one that you are familiar with called future markets. If you buy now, buy in a now market and sell in a now market, you will be better off because you will know where the market value line is. Whereas if you buy now and sell later, you have no idea where the market value line will be. This brings uncertainty into the investment. Buying in now markets and selling in now markets will always be a benefit to you. The laws are the same, taxation will be the same, finance or borrowing conditions will be known, costs of transactions will be known, estimated profit should be realised. But up until now, we have only considered tangible assets, but this diagram works equally as good for intangible assets. A lot of players in the share market do not know how to quantify intangible asset values or brand values, and in most cases, purchased goodwill will always be expressed as the price paid with no explanation to its relationship with market values. Again, this is where my market activity diagram comes into a force of its own, because it will always allow interpretation of the facts in a clear and concise manner in a graphic format. In Australia, some years ago, a large public company purchased a small private business for $20 million based on the relief from royalty method, which has no bearing on market activity whatsoever. At the time of purchase, the tangible assets were recorded at $1 million, which equates to $19 million for goodwill. The net profit was only $100K, meaning it would take 190 years to get your money back on a simplistic basis. There were no other players in the market at the time to create competition for the asset. Why in the world would anyone pay such a ridiculous figure when they held all the aces? If I were a shareholder in this public company, I would have been fuming, and I would want to get away from such stupidity. The best investments are those that create cash flows or reliable cash flows, then growth, not growth alone. This rules out vacant land investment unless you are a builder, and it does not satisfy the laws of cash flow. Growth or speculation generally generate risk. Higher returns are possible, but so is the risk of losing the lot. The only constructive asset that can't be stolen and is cheap to insure and grows in value is real estate. There is a quote by Mark Twain, and it says, "Buy land now, God's not making any more." That concludes today's presentation, and all of the above can be found in my book. I hope you get your copy soon. Thank you for watching.